Tampa still attracts buyers and relocation interest, but when we look beyond the headline demand story, the investment picture is much weaker. Home values are declining, rent growth is negative, properties are taking longer to secure contracts, and new housing supply remains elevated. The new urban capital signal stance for Tampa is reduced. That does not mean every Tampa property is a bad investment. It means broad exposure at ordinary market pricing is not attractive enough right now. This dashboard does not make a market decision from one price number. It evaluates 6 signals that matter to investors. Migration demand tells us whether new household demand is actually forming. Pricing power measures whether values and seller leverage are improving. Rent support looks at rental growth and vacancy. Inventory measures supply relative to absorption. Market velocity shows how quickly properties convert into contracts. And new supply risk tracks the future competition coming from construction. For Tampa, the current read is moderate demand, weak pricing power, weak rent support, balanced inventory, weak market velocity, and elevated new supply risk. The reduced stance is a market allocation decision. It does not mean an existing owner with low fixed rate debt should automatically sell. It does not mean there are no good deals in Tampa. It means investors should reduce appreciation-dependent exposure and only buy when the property has unusually strong current economics. The deal should work because of the purchase basis, existing cash flow. It should not require rapid rent growth or broad market appreciation. The first important signal is pricing power. Tampa's Zillow Home Value Index is down 2.9% year over year. At the same time, the median sale price is up about 3%, and the Redfin Home Price Index is up 1.9%. That may look contradictory, but these measures answer different questions. A median sale price can rise because a larger share of expensive homes sold during the period. The Zillow Index is designed to measure broader home value movement, so the dashboard does not treat the higher median price as proof that broad appreciation has returned. Seller leverage is also limited. The average sale-to-list ratio is 96.9%. About 25.7% of active listings have had a price reduction. Mean days to pending reached 68 days, up 11.5% from last year. Redfin's median days to market is 46 days, and the pending sale cancellation rate is 16.9%. For investors, this means slower exits, more carrying costs, and less room for an optimistic resale assumption. The next question is whether rental income is per today's acquisition and financing cost. Tampa's observed rent index is down 0.7% year over year. Rental vacancy is 7.3%, and the 30-year mortgage rate is approximately 6.7%. This combination creates pressure. Insurance, taxes, maintenance, and financing costs can rise even when rent does not. That makes aggressive rent growth assumptions difficult to defend. A new rental acquisition should work with current rents and conservative renewal assumptions. If the return only becomes acceptable after a large rent increase, the underwriting is too dependent on a market recovery. Tampa's demand signal is moderate, not strong. Redfin shows net migration search flow about 4,819, up more than 70% from the prior year. That confirms that Tampa still attracts attention, but search activity measures intent. The harder indicators are weaker. Population grew only about 0.4%. Domestic migration was slightly negative. Pending sales declined 1.8% year over year. Unemployment reached 4.7%, and total non-farm employment was almost flat, growing only about 0.2%. The dashboard separates relocation intent from realized economic demand. Investors should underwrite actual households, leases, and transactions, not online search traffic alone. Inventory is labeled balanced. Tampa has about 4.2 months of supply. For sale inventory is down 8.3% from last year. That is an improvement, but inventory remains about 30% above the 2019 level. New listings are also running above newly pending listings. So the market is not severely oversupplied, but it is not operating under scarcity either. New supply risk is elevated. Tampa authorized 22,747 housing units in 2025. That is up 8.6% year over year. It equals about 6.7 permits for 1,000 residents, and 38.6% of the permitted units were in buildings with 5 or more units. The county view also shows that weakness is broad. Home values decline in Hillsborough, Pinellas, Pasco, and Hernandez counties. Rent growth is negative or nearly flat across all four. Pinellas had the slowest velocity at 76 days to pending. This is why investors need to study the specific county and submarket instead of relying only on the Tampa metro name. For existing owners with a low fixed-rate debt and stable occupancy, the priority is defensive cash flow management. Maintain occupancy, control expenses, preserve liquidity, and avoid unnecessary refinancing. For new buyers, ordinary retail pricing is not enough. A property should offer a clear advantage, such as a meaningful discount, strong in-place income, realistic operational upside, or limited direct supply competition. For flippers and short-hold investors, use longer sale timelines, higher carrying costs, and more conservative resale values. A project that only works with a fast sale is not adequately protected in the current market. The Tampa stance could improve from reduce toward hold if several conditions change together. Rent growth needs to become clearly positive. Days to pending needs to fall. The sale-to-lease ratio should improve toward 98% or higher. Actual population and domestic migration should strengthen, and new supply needs to be observed without deeper rent concessions. One positive migration headline would not be enough. The improvement must appear across prices, rents, transactions, and absorption. The bottom line is simple. Tampa remains a desirable and important metro, but desirability alone does not guarantee a strong investment return. Right now, the better opportunities are likely to come from asset-specific mispricing, motivated sellers, operational improvements, and superior micro-locations, not broad market appreciation. What matters the most to you in Tampa right now? Cash flow, pricing, or new supply? Do you agree with the reduced stance? Comment below if you'd like to access to the interactive dashboard. The written analysis is linked in the description. They include the historical chart, county comparisons, source dates, and the conditions that would change the UCS view. This analysis is for market research and education, not individualized financial advice.